Good morning, dear student. Today I'd like to explain you dissolution of partnership firm. In this chapter, we are going to learn at the time of dissolution of partnership firm what kind of accounting treatment and processes we should follow it. So there are two terms, dissolution of partnership and dissolution of partnership firm. So dissolution of partnership means termination of old partnership agreement and reconstruction of the firm due to admission, retirement and death of a partner. Dissolution of partnership firm means that the firm closes down its business and come to an end. Means whenever dissolution of partnership firm take place, business going to end. All the business activity is going to end. The firm is going to wind up. So dissolution of partnership is only dissolve the present agreement, but business is not going to end. So already we have discussed in the class all the theory part. I'm directly coming to the practical part. So at the time of dissolution, the simple in a layman's sense, at the time of dissolution of firm, what the firm used to do is all the assets of the firm will be sold out and all the liabilities will be paid out. So to complete this process, as an accountant, we have to prepare a realization account, partners loan account, partners capital account, cash or bank account. So preparing a realization account, the nature of realization account is nominal account. All the incomes should be credited and all the losses should be debited. So the purpose of preparing realization account to close all the assets and liabilities given in the balance sheet, and to calculate the profit or loss on realization. So closing assets, whatever given in the balance sheet, it can be understood in this way. This is a balance sheet. This is a balance sheet. And right now, first I would like to talk about how to close all the items given in the liability side. So if you see this on the screen, all the liabilities given in the balance sheet at the time of dissolution firm. So first of all the outside liabilities will be transferred to realization accounts such as sundry creditors, bills payable, bank overdraft or bank loan, employees provident fund, relative of partner, loan from relatives of partner, outstanding expenses and advance received income. These all are outside liabilities. They will be transferred to realization account. Apart from this, if partner's current account has been given in the question, then it will be transferred to partner's capital account. For transferring the liabilities, all the outside liabilities like these one, the journal entry for this sundry liabilities account debited to realization account, and for transferring this current account, the journal entry will be partners current account debited to partners capital account. The concept for workmen compensation fund is, if there is no liability against workman compensation, then all the amount will be written off among the partners in their old ratio. If there is any liability towards workman compensation, there can be two situations. Either the liability is more than fund, or liability can be lesser than workmen compensation fund, or there could be another possibility that actual liability towards workmen compensation equal to workmen compensation fund. So if work liability towards workmen compensation is lesser than the fund, then the amount equal to the liability will be transferred to the realization account, and the journal entry will be workmen compensation fund account debited to realization account, and remaining amount will be distributed among the partners in their old ratio, and the journal entry will be workmen compensation fund account debited to partners capital account in their old ratio. Suppose liability is more than or equal to the workmen compensation fund, then whole amount of workmen compensation fund will be transferred to realization account, and the journal entry will be workmen compensation fund account debited to realization account. For investment fluctuation fund, the concept is, if there is on the asset side, if investment is not given, then this whole investment fluctuation fund will be written off among the old partners in their old ratio. But generally, as on the asset side, investment has been given against this investment fluctuation fund, so at the time of realization, the investment fluctuation fund in general will be transferred to realization account, and the journal entry will be investment fluctuation fund account debited to partners capital account. Apart from this, if partner has given loan, this one I'm talking about, if any partner has given loan to the firm, then we will open a new account at the time of dissolution and we will pay it there. Apart from this, if reserves and surplus are given, these reserves and surplus will be written off among the partners in their old ratio, and the journal entry will be reserves and surplus account debited to partners capital account in their old ratio. Now on the credit side, on the asset side, this is the situation. So on the asset side, if partner's current account is given, like C is showing debit balance, if current account shows debit balance, definitely it will be shown in the asset side. So if partner's current account has been given, then it will be transferred to partner's capital account, and the journal entry will be partner's capital account debited to partner's current account. If firm has given loan to the partner, then it will be transferred to partner's capital account at the time of dissolution, and the journal entry will be partner's capital account debited to loan to B. Now investment, all the asset, and the concept for asset is all the assets which are supposed to be realized in cash, like in investment, sundry debtor, machinery, goodwill, building, patents, stock. These all the assets which are going to be sold and realized in cash, they will be transferred to realization account, and the journal entry will be realization account debited to sundry asset account. And if any asset is attached, if there is any provision attached, if any provision attached with the assets, then these provisions are transferred to realization account, and the journal entry will be provision for doubtful debt or provision for depreciation account debited to realization account. In this case, we will transfer the asset with its gross value, and provision will be transferred with. We will not use this amount. We will not use this amount. We will use first asset will be transferred with its gross amount and provision will be transferred with its amount 5,000 or 1 lakh. Right. Apart from this, cash and bank account will not be transferred in realization because it is already realized amount. So at the time of dissolution, we will open either cash or bank account. If suppose in the question asset side cash and bank both are given, then either you can open cash account. Suppose cash balance is more than bank balance, then you will open cash account and you will withdraw the amount given in the bank and you will pass the journal entry that cash account debited to bank and you will enter in the cash book cash account, and rest of journal entry for the cash payment or cash receipt you will use cash. Suppose bank balance is more than cash balance, then what you will do, you will open bank account. You will whatever the balance given in the whatever the balance of cash is given, that will be deposited. For depositing the cash, journal entry will be bank account debited to cash and you will put it into the bank account. Apart from these advertisement suspense account, profit and loss debit balance, deferred revenue expenditure balances, these are accumulated losses and it will be at the time of dissolution that will be written off among the partners in their old ratio, and the journal entry will be partners capital account debited in their old ratio to fictitious assets like advertisement suspense account, profit and loss account or deferred revenue expenditure. With this the whole concept has been completed. Apart from this, at the time of dissolution, if any assets are unrecorded assets are given, if any unrecorded assets are given at the time of dissolution, then they will be realized, and the journal entry for this unrecorded asset will be for unrecorded assets. If there is any unrecorded asset at the time of dissolution, then the journal entry will be cash account debited to realization account. Or if any partner has taken unrecorded asset, then that partner's capital account debited to realization account. Suppose any unrecorded asset has taken over by the creditor, then unrecorded creditor, then no entry is required to pass. Right. For realization of assets, whatever already recorded, the journal entry for that is same cash account or bank account debited to realization account. If any partner has taken asset, then the concerned partner's capital account debited to realization account. If any creditor has taken recorded asset, then again there is no entry is required. Only if any balance amount has been paid to the creditor, that journal entry you will pass, and the journal entry will be realization account debited to cash or bank. Or if any partner has paid out, then partner's capital account will be credited. For liabilities, unrecorded liabilities, if at the time of dissolution there is unrecorded liability, that will be paid off. So the journal entry will be realization account debited to cash or bank. Or if partner has paid, then partner's capital account will be credited. And these two entries are same for recorded asset which are already in the books. If they are paid out, then the journal entry will be realization account debited to cash or bank, or to partners capital account if partner has paid. So one important thing you must remember at the time of dissolution, that if in the question no information has been given about the realization of any asset, then we will assume that nothing has been realized from that asset. But for the liabilities, even in the question no information has been given for the payment of any liability, you must pay if you must pay all the liabilities given in the balance sheet. So this is must. So this is all about the concept related to dissolution, accounting concept related to dissolution of partnership firm.